Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. So today we are going to do on international finance, right? This will be our last topic, okay, for this semester for Math 603. Okay, this is the chapter outline, okay. Many subtopic, okay, some of them you have to go through on your own, okay, and right, so as a starting point for this particular chapter, we will go to the introductions of the exchange rate quotation, right? So what is the exchange rate? Exchange rate at which one country's currency, right, can be traded, exchange for another country's currency. Like for example, the rates which are quoted as 6.94 RMB against US dollar. So that means for every US dollar, it can be exchanged for 6.94 RMB. So in other words, right, if you want to buy $1, then you have to pay for $1 of 6.94 RMB. Right, and then the exchange rate can be quoted directly or indirectly. So for a direct currency quotes, right? So this is where a direct quote is the amount of domestic currency which is equal to one foreign currency unit. For example, if you want to get one US dollar, the foreign currency is the US dollar. So if you want to get one US dollar, so you have to pay 4.2 ringgit Malaysia. So that is what we meant by direct quote. So that is RM 4 ringgit 20 cent against one US dollar. If it's an indirect quote, all right, so this is the amount of foreign currency which is equal to one domestic currency unit. So that means just now we go to a direct quote currency where for every one ringgit for every ringgit US dollar, you have to pay 4 ringgit 20 cent, right? So here we go the other way around, which is for every ringgit Malaysia, then how much we're going to get in US dollar. So that means, so for $1 equals to 4 ringgit 20 cent. That is if it's one ringgit Malaysia. So 1 ringgit divided by 4 ringgit 20 cents. So it's going to be 0.38 dollar. Okay. So that is what we mean by direct and indirect currency codes. So most of the country use a direct codes. Okay. So we go back to the slide, right? Um, we go to the example. Okay, so let's say you have $10,000 based on the rates given here. You have you want to convert the US dollar into Swiss franc. So then how much you can get in Swiss franc? Okay, if you use the exchange rate of for $1, okay, the Swiss franc against US dollar, which is zero equals to 0.78799 franc, okay, per dollar. Okay, so that means if you have $10,000, so you are going to get 8,799 francs. Okay, so you make sure you know how to calculate. That is for, let's say here, if I show you, all right. So that means 0.87999 franc equals to $1. Okay, $1. Okay, so therefore, if you have $10,000, so that means if you have $10,000, okay, $10,000, okay, it will equals to how much? 10,000 multiplied by 0.8799. Then you will get 8799 franc. So that is how you calculate. Okay. Another example, you can see, let's say you are visiting Bombay and you are in India and you want to buy a souvenir that costs you 1,000 rupees. So how much does it cost in US dollar? Okay, so let's say the exchange rate at that time is again the exchange rate of rupees against dollar equals to 46.650 rupees per dollar. Okay, and then you want to convert rupees into dollar. Okay, so how is it? So let's say here, uh, right? So let's say the exchange rate is 46.650 rupees equals to $1. Okay, and then that means if it's cost you 1,000 rupees, so how much should be in dollar equals to, so 1,000 rupees you divide by 46.650 rupees, then you will get in dollar 21.44 dollar. Okay, so that is how it works. That is how you calculate or to convert the currency. Okay, now we go to the depreciation and appreciation of foreign currency. Okay, this is quite confusing. Okay, but we go through slowly here. Okay, so what's the meaning of depreciation and for appreciations of foreign currency? First, you need to know what is the foreign currency that you are going to use or you want to convert to. Okay, so if the foreign currency depreciates, right, that means, all right, this is implication, it is now worth less in our home currency. How is it? So let's say our foreign currency here is in euro. So what is the implication if euro currency depreciate? Okay, maknanya decline dia punya currency tu. Okay, so the implication is that if you do a export, right? If you are the exporter, that means you will receive in euro, and then you convert to your home currency. That means you are going to get less in your home currency, right? If you do the import, that means you buy the goods or services from foreign country that is trading in euro, then that means you have to pay the for that particular goods in euro. So that means so you have to pay less in your home currency. Okay. So when the foreign currency depreciate, that means your the home currency is appreciate actually, right? So if the foreign currency is depreciating, that means your home currency is appreciating the other way around. Okay, for example, I'll give you here, right, let's say 1 euro equals to 4 pounds. Okay, this is current currency. So let's say in the following days, right, or following weeks, you found that 1 euro now becomes 3.9 pounds. So that means in order to get 1 euro, okay, in order to get 1 euro, you have to um, pay less pounds. Okay, so that means 1 euro become cheaper now. That means if you do the export, if you convert the euro into pound, then you will receive less in your pound currency. But if you do the import, I mean you have to pay in euro, right? So that means you will pay less because the what home currency is appreciating. Okay, then this is another example. So then what would happen? Okay, what would a strong pound appreciated means for companies in the UK pricing transaction in foreign currency? So let's say foreign currency is euro here. Okay, if they were a UK exporter and if they were a UK importer. So let's say mention here the currency, the pound currency, right, is strong. That means it is appreciated. Right, so I show you here the pound has appreciated against euro. So therefore, the euro has depreciated relative to the pound. So in mathematically, you can show here pound sterling equals to euro against euro, which is pound is appreciating, becomes stronger than euro currency. It's depreciating. So what happened to the UK exporter? If it's export, then it's a bad news to them. Why is that? They will receive less in its own or in their own currency or home currency. Okay, because their currency is appreciating as compared to the foreign currency. So that means you will receive less pounds or fewer pounds. So how to get more pound? That means you have to sell your or export your goods or services and charge at higher foreign currency price. So but then the negative impact is that your product in the foreign countries will be less competitive then. So there maybe will be no demands for your goods and services. But what about if you are the UK importer? So if you are UK importer, that means your currency is appreciating, right? Stronger than the foreign currency. That means you will pay less. So this is a good thing for the UK company or importer. Okay, the next one is what happened then if the foreign currency appreciates. That means foreign currency appreciates, so automatically the home currency is depreciating. Right, what happened then if the home currency is depreciate, like our country, Malaysia, ringgit Malaysia is depreciating against US dollar, right? So that means if we want to get $1, we have to pay more. So dollar become more expensive now. So if you buy product or goods from US dollar, then you have to pay more in RM, right? Okay, so what happened? If you are the exporter, right, you will receive more in your home currency. Okay, it's contradict from the other situation just now. Okay, if you doing the importing, right, imports, right, so you are the importer, that means you sell your product, so you will end up that you will pay more in your home currency, right, because your currency become depreciated now, right, as compared to foreign currency, then you have to pay more. Okay, all right. It's a bad thing for importer, but it's a good thing for the exporter. Okay, so this is the example, simple example to show the appreciate and depreciate. Just previously, what we mentioned, the foreign currency depreciate. That means our home currency is appreciating. But what happens if foreign currency depreciate? Appreciate. That means our currency is depreciate. Okay, all right. Understand? Okay, so I hope you understand, right? Okay. All right. Then another example, what would a weak euro? That means weak euro, that means depreciated, like euro currency depreciating, means for the companies in the Eurozone pricing transaction in foreign currency if they were exporter and if they were the European importer. So, so what does it mean in the whole situation here? So that means, let's say home currency is euro and foreign currency is other currency. We do not know here. I just give you a general example here, right? So the euro has, that means the euro currency become depreciated. That means euro has depreciated against, the euro has depreciated, and therefore other foreign currency have appreciated. Whatever currency you want to refer to, it's up to you. Okay, relative to the euro. So if we put in equation, so that means for one other foreign currency, okay, it will equals to a euro, okay, and then let's say a weak euro, that means other foreign currency is appreciating, and automatically euro is appreciating. Okay, right. So what happened to the European exporter? Okay, if it's export, when the foreign currency now is appreciating, so that means your currency depreciating. So when you export, what happened? You will receive more euros. Okay, you will receive more your in your currency. I mean your home currency. Okay, if you convert, you will get more. But what happens if you make a payment for your imports? So For European importer, it's a bad news, like I said, because you have to pay more. Okay, all right. Next, so this is the illustration, right? So you are given the current exchange rate between US dollar and UK. So this is the US dollar against pound sterling, right? So this is the current exchange rate. So you compare this to this. Let's say in the next day, the currency become, okay, the exchange rate become like this, which is 1.7 dollar equals to 1 pound. So that means, what does it mean? So that means the foreign currency, pound sterling, is what? Is appreciating, right? And dollar currency is depreciating. Why is that? Because, right, we have to pay more dollar in order to get 1 pound. Okay, right. So what happens if you receive 10 million? Then you convert into pound. Then you will get 5.88 pound. Right. So what happened if you found that the currency now becomes 150 dollar equals to 1 pound, so that means the what, the from 1.60 it becomes 1.5 now. So that means you pay less dollar to get 1 pound, right? So that means dollars currency now is appreciating, and then that means what, the pounds, pound sterling becomes what, depreciating. It depreciated. Okay, so what happened if you receive 10 million? So that means you will receive more in pounds, right? So this is a comparison. Okay, if the currency, home currency or foreign currency here are depreciating and appreciating. Right. The next part that you need to know on this particular topic or in this particular topic is about bid and offer prices. So basically, this is dealing with bank. When we deal with bank, right, in order to exchange the currency from home currency to foreign currency, or from foreign currency to home currency. Right. So banks dealing in foreign currency often will quote using spot currency or spot rate or forward rate. So we will go in detail about spot rate and forward rate later on. So but here I want to explain to you what is the bid price and what is the offer price. So the bid price or selling rate by company, right? This is the rate bank is willing to buy. Okay, bid price is the exchange rate that the bank's willing to buy. Okay, offer or bid, sell, offer or ask price, offer or ask price or buying rate, okay, by company. Okay, this is the rate, all right? Bid and offer, they just focus on this one. Bid is actually the rate that the banks are willing to buy. Offer or ask price is the rate that is the bank is willing to sell, right? The difference between buy and sell is called a spread. Okay, here give you a simple example, right? So the example here is what is it? The US dollar against pound. That is the spread or the exchange rate, right, for 1 pound is equals to between $1.34 to $1.345. Okay, right. So the bank will offer, right, and bid. Okay, right. The thing is that at what rate the bank will buy, at what rate the bank will sell. Right, there is a rule of thumb where the bank will buy at high and will sell at low. So that is the rule that the bank will follow. So the bank will buy at high rate. So they will buy the currency at this 1.345, the higher rate, and the bank will sell at low rate. Okay, low rate which is 1.340. Why is that so? Kita akan nampak the reason why the bank sell at low and buy at high later on from the example. Okay, right. And the next example here, sometimes, okay, the exchange rate will be quoted as the mid price with an adjustment. For example, here, sometimes they will give you the range between this range, right, against pound, or they will give you mid price. Mid price, that means they will give you the basis rate, the current rate, right? Okay, the base rate, which is 1.3425, and then it will be plus or minus. If it's plus, it will be the higher rate. If it's minus 0.0025, then it will be the lower rate. So it will be like this. So this tell you to add 0.0025 to get the buying rate, because the bank will buy at high rate. Okay, that means the range is between, later on, the range will be between 1.345 and 1.340. How do you get this? This is where 1.3425 you minus 0.0025. So you get 1.325. So that means if you put in the range, so that means it's equals to, what is it? 1.3425, okay, will be 1.3245 to 1.340 higher rate, okay, equals to 1 pound. Okay, let me show you. Equals to, right, 1 pound. So this is US dollar. Okay, so it will be like this actually. Okay, after you plus and minus the base rate here. Understand? Okay, all right. Now, this is the points that you need to remember, the rule of thumb. Okay, from the transactions between the bank and the company, right? Where the banks will buy at high and the bank will sell at low. Okay, we take this example, right? Just now, the example is how the bid and offer price are quoted by the bank. So here, an example, what rate that banks will use, okay, to buy and to sell the currency. Okay, let's say the US rate per pound is, the US dollar rate per pound is quoted as follow, which is between 1.4325 and to 1.4330. So now we know that 1.4325 is the low rate and 1.4330 is the high rate. So this is the US dollar rate currency against the pound sterling. So for 1 pound, then you have to bear with the exchange rate of between 1.4325 and 1.4330. So this is example for the first one. Let's say there is a company that is called as company A wants to buy $100,000 in exchange for sterling. So how much sterling? So that means the company wants to buy. So if this is the case, what happened actually? The company wants to buy dollar from the bank. So this company will carry the pound. That means how much pound this company should uh, pay to or should give to the bank in order to get $100,000. So how are we going to do that or to deal with this kind of situation? So look at the next slide. So let's say the company wants to buy $100,000. Biasanya it will apply to importer or imports company. Okay, where the company wants to pay in foreign currency. So that's why. So let's say they want to buy $100,000 in exchange for sterling. Okay, they want to pay in 100 in dollar. Okay, if the company wants to buy in dollar, okay, home country is pound. So that means um, the company has to convert the pound into dollar. So the company has to buy the dollar. If the company wants to buy the dollar, that means what the bank should do? The bank will sell the dollar. Okay, if the company wants to buy $100,000, then the company has to buy this $100,000 from this company. Okay, so that means, what is it? Right, in this case, company buy dollar, right? Company buy dollar, right? Bank will sell dollar. Okay, so that means banks will sell the dollar. Alright, so how is it? Okay, the next one, kita dah tahu dah, bank will sell dollar. And next issue here is the bank should determine which rate that the bank should use. So we have the range between 1.4325 low rate and 1.4330, which is the higher rate. So we know that the bank is going to sell the dollar. So if the bank want to sell the dollar, the rate that the bank should use is the low rate. That means the bank has to use the 1.4325, not 1.4330. So if using 1.4325, right, to sell the dollar, so that means how much pound that the bank will sell to the bank would sell them for how much? 69,808 pound. Okay, so that means this is the amount, right, the bank will receive from the company. Okay, the bank will receive 69,808. If the bank use higher rate, you can see that 1.4330, right? That means the bank will receive 69,784 pounds only. Right? Company will bring this pound to the bank in order to get the dollar. So the bank will receive 69,784 pounds only if the bank use this rate. So that's why now you can see the bank will be better off to what? To sell the dollar, right, to the company at low rate because they want to get more pounds. Are you following? Okay, so hopefully you know. Okay, if you look at the rule of thumb here, you would sounds that when the banks sell at a low rate, so you might say hello. All right, so it sounds like ridiculous, eh? But then if we calculate, so that means it's giving benefit to the bank actually, eh? Right, so the next one, another example here is where the next company, let's say company B, wants to sell $200,000. So they want to sell $200,000 to exchange from dollar to, or to convert the dollar into sterling, right? So maybe this is for the exporter, will be for the exporter. Okay, so this is whereby the company, let's say, want to sell $200,000 in exchange for sterling. So what happened when the company want to sell the $200,000 in order to get pound sterling? So what the bank should do then? So the bank should buy. The company wants to buy. Now the company wants to sell because they want to get the pound sterling. Okay, right. So then what the bank should do? The bank should buy the dollar from the company. So now the bank is buying the dollar. So then the question is what rate the bank should use in order to buy this dollar. So we know the rule of thumb, the bank will buy at high. Okay, so at high rate. So why is that? You can see here, if the bank buy at high rate, 1.4330. So the bank, right, would buy them for £1, 139,567 pounds. Okay, so that means, right, the bank will give them, right, convert the $200,000 for 139,567 pound. Okay, as compared to the other one, if the bank used the lower rate, so the pound that should be given by the bank to the company is 139 and 616 pound, which is higher, all right, than the earlier one. So that's why the bank will use the higher rate to buy the dollar currency, right? So it gives benefit to the bank actually. Okay, right. So hopefully you can get a clear picture here, right, from this second example. Okay, the next one is another example. Okay, let's say you are an Australian exporter, okay, and then need to change, right, to convert the 30,000 euro from an overseas sale. So that means you are the exporter. You sell your goods to in foreign countries, right, and you receive the 30,000 euro, okay, the foreign currency, and then you want to convert into Australian dollar, Aussie dollar, right, AUD. Okay, and the exchange rate here is quoted in mid, what is it we call it today? Um, I forgot, so let me, mid price, right? So they give you the exchange rate quoted in mid, plus minus, is it? Oh no, it's not mid price, it's a range, right? Between 0.6833 to 0.86, sorry, 6843. Okay, so this is the euro currency against Aussie dollar. Okay, that means how much Aussie dollar will you receive if you convert this income, 30,000 euro, into Aussie dollar. So now the next step, the first step you should do is you have to identify whether the company sell the currency or buy the currency. Okay, right. That means to convert the Aussie dollar plan wants to convert the euro dollar, the euro currency to Aussie dollar, right? So that means Aussie company is the exporter, export the goods and which sell the goods in euro lah, okay, and receive the euro currency. So that means what? Right? That means what? The Aussie company sell the euro, correct? That means here, okay, the Aussie company sell the euro 30,000 to the bank, and the bank will buy the euro. So how much or what at what rate the bank will buy the euro? So that is the next step. The first step you need to determine to identify whether the company is selling or buying the currency. Okay, if it's buy, that means the bank has to sell, right? If it's sell, right, if the company sell the currency, that means the bank has to buy. So in this case, the company sell the euro, 30,000 euro to the bank. So dia bawa duit ni ke bank dalam bentuk 30,000 euro, right? Sell this euro to the bank. And what the bank does, the bank will buy this euro. So at what rate, the second step, so the rate that will be used by the bank is what? Buy at higher rate. So that is the rule. So the banks will buy the currency. So that means how much the Aussie dollar will get. So this is the calculation here. So you need to use this, right? Buy at high. So the bank will use this rate 0.6843. Right, for 1 Aussie dollar, it equals to 0.6843 euro. So that means if this company bring the 30,000 euro to the bank, so that means 30,000 euro will divide by 0.6843, then you will get Aussie dollar of 43,840 dollar. Okay, right. In another situation, let's say here you are a US importer. That means you buy the goods or services from foreign country, and let's say the foreign country here is India, right? So the India is in rupees. So that means you import. That means you will pay the um, for the product in India in rupees, and that costs you 500,000 rupees. And then the exchange rate quoted here, for example, here is the exchange rate quoted for rupees against US dollar is 60.1853. between 60.1853 and 60.2354 for per US dollar. So here, how many US dollar will that cost for this 500,000 goods, right, or product in India here? Okay, so first step, you need to know whether the US company here, the importer, will buy or will sell the rupees. So here, the company wants to convert the US dollar into rupees, right? Because the company, US company, wants to pay in rupees. So that means the company will buy rupees, correct? So the company will buy rupees from the bank. And then what the bank does, the bank will sell the rupees. But here, the next issue here, what rate that the bank's going to use in order to sell this rupees currency to the US company here. So sell at low. So the company will use 60.1853, right, to sell the rupees to this company. So look at this one. So that means you will buy the rupees, right, for 500,000. Alright, from the bank. That means you will carry your US dollar. How much US dollar you should bring to the bank in order to buy these rupees. So that means bank will use 60.1853 rate, the lower rate, sell. Okay, so then what is it? How to determine? So if that means 60.1853 is equals to $1. So that means if 500,000 rupees will equals to divide by 60.1853, the low rate, because the bank is selling, right, and multiply by $1. So you should pay the bank $8,308. Then you can get 500,000 rupees. If you pay less than this, that means you cannot get this 500,000. Okay. All right. Okay, any questions so far? If you have any questions, maybe you can ask me later, right? Okay, next, we go to the next part of this particular topic, which is the types of rates. Like I said, the bank can quote the exchange rate at spot rate or at forward rate. Okay, so what is the spot rate? What is the forward rate? So we look at the first part here, which is spot rate. So the spot rate is actually the exchange rate, right, that is currently offered for an immediate trade. So the spot rate is actually the current exchange rate. So let's say today, today's rate. Okay, so that is what we call spot rate. So this spot rate is actually can be available on the spot market. Okay, for the currency, spot market of the currency. So what is the spot rate? And spot rate is normally used in the spot trade. What is a spot trade? Spot trade is an agreement, right? It's an agreement or it's a contract to exchange the currency on the spot using the spot rate. Okay, and which the transaction will be completed or settled within 2 business days. Right, that must be completed and must be settled within 2 days, business days. Right, and the exchange rate on the spot trade is called the spot rate. Okay. So you trade in the spot trade, right? You trade the currency, right, in this spot trade using the spot rate. So spot rate is the current rate, current exchange rate. Okay. The next one, you go to another types of rate, which is forward rate. So forward rate is actually available or will be used in the forward trade. So what is forward trade? Forward trade is the transaction which you agree today to exchange the currency at some future date and some specified price. That is also called as a forward contract. Okay, so that means in the forward trade, you will trade the exchange or the currency using the forward rate. And this forward rate is actually the rate of exchange, right? That is set, okay, now, right, for currencies to be exchanged, but it can be exchanged or will be exchanged at a future date specified in the forward contract. Okay, So in other words, it is a fixed predetermined rate. So you have set or you have fixed the exchange rate today to be used in future. All right, to be used at the specified rate in future. So let's say in 3 months time, lagi 3 bulan. But you have set the rate, the exchange rate today. So you will be using this predetermined exchange rate here in 3 months time. Okay, or for the forward contract, okay, within the forward contract period. Right, if the forward rate is higher than spot rate, that means the foreign currency is selling at a premium. Okay, so that means the bank will subtract it from the spot, will subtract, okay, this premium from the spot rate. Maknanya dia kena tolak. Kenapa tolak? Sebab kita sebut premium, it will plus, right? Okay, will be added. But then in this case, it's the other way around. Okay, you can see later on why is it subtracted from the spot rate for the premium. Okay, if the forward rate is lower than the spot rate, the foreign currency is selling or will be selling at a discount, right? That is, this discount will be added to the spot rate. You akan plus dengan spot rate. Spot rate is apa tadi? Current rate. Okay, kalau premium dia adalah 0.5 and then spot rate dia adalah 1.5, so that means currency dia will become 2. Okay, kalau katakan current rate dia tadi spot rate is 1.5 and the premium is 0.5, that means you kena minus, so then the currency will become 1. So that is the difference between the premium and discount. Okay, right. So we go to the example, right? Example of the here quotation for the spot rate and forward rate lah, and then here is for forward rate, forward contract, right? Okay, so quotation of forward rates in forward contract. So let's say the bank will quote a spread between on the a spread based on the forward bid and offer prices. For example, dollar against euro. 3 months forward rate might be quoted as, right, for against the what? For 1 euro, okay. So the US dollar will be between 1.3495 and 1.3525 per euro. Okay, or maybe it can be quoted as a mid price just now, where the spot rate is 1.3510, you plus minus 0.0015, then you get this range. So it's just the same thing, it's just a matter of the way that the bank will present this particular exchange rate per foreign currency. Okay, now look at this example. So let's say an Australia firm or company has just bought some machinery. So buy machinery, a machinery from US supplier, so that is in US, for the cost of 250,000 US dollar, right, with the payment which is due in 3 months time. Okay, in 3 months time, and then the exchange rate are quoted as follow. Okay, current rate, right, current exchange rate for US dollar against Aussie dollar, right, Aussie dollar is 0.7785 to 0.7891. So this is the spot exchange rate ataupun spot rate, maknanya today's rate. Let's say today, right, let's say it is a 2 days rate. Okay, if it's this Australian firm enter into the forward contract, let's say the Australian firm use this forward rate, all right, in 3 months forward is exchange rate against Aussie dollar, right? There is a premium of 0.0021 to 0.0018 cents premium. So that means this is the lower premium, this is the higher premium. Okay, right. If it's a premium, so you must bear in your mind, if it's a premium, like I said or mentioned here, if it's premium, it must be what? Subtracted from the spot rate. So we know the current rate. given here, that means you can determine the forward rate using this premium. Sometimes, right, the information given is very straightforward, whereby they simply minus the premium, okay, and then get the final exchange rate per Aussie dollar. Okay, let's say here required, calculate the amount payable, right, the amounts payable for this machinery if a forward contract is used. Okay, if a forward contract is used, that means you have to consider the premium here. If you are using spot rate, so let's say you are using spot rate, okay, the spot rate is between 0.7785 to 0.7891 per Aussie dollar. So the thing is that which rate the bank will be used in this case. So you have to know whether the company is buying the currency or selling the currency. So here we know that the Aussie firm buys the machinery in US. So the Aussie company or firms must pay, right, must pay in US dollar. So that means the Aussie company has to buy the US dollar. So company will buy US dollar. So company akan bawa Aussie dollar to the bank to buy the US dollar because they want to pay in US dollar to the US supplier. So that means Aussie company will buy US dollar and the bank will what? The bank will sell the dollar to the Aussie firm. So the Aussie firm will get the dollar and pay for that machinery. So here, what rate the bank will be used here? So we have two rate, higher and lower, right? Higher and lower. So which rate? So the bank will sell the US dollar. So sell at what rate? The rule of thumb said that sell at low rate. So the bank will use 0.7785 to sell the US dollar. So that's why if the if the Aussie firm, okay, using spot rate, right, then in order to get US dollar, right, the firm has to pay 321,130 Aussie dollar to the bank. So that baru dia boleh dapat 250,000 US dollar. But what happened, okay, if the Aussie firm here using forward rate, that means enter the forward contract, right? Enter into the forward contract. So what is the rates that's going to be used and what rate that is fixed in that particular contract or specified in that contract, then you need to know the discount or the premium. So here it is mentioned in the example, it's a premium. So therefore, premium must be, what is it? Must be subtracted from the spot rate, current rate. So we knew already if you are using the spot rate, that means we are using low rate and bank will sell at low. So that means kita akan terus guna the lower premium. So lower premium must be minus from the spot rate. So therefore the spot rate, lower spot rate here will be minus the premium. So that's the rule. Premium must be minus, discount must be added. So this is the premium, you minus 0.0021. So therefore, the lower rate here becomes 0.7764, which is lower than the current one. So what happened? You want to determine now what happened next. Okay, you will need to determine how much that the Aussie firm has to pay to the bank in order to buy the US dollar, in order to get 250,000 US dollar. So the payment in 3 months time is what? Equals to 250,000 US dollar here, right? And you divide by 0.7764. You need to use the forward rate lah instead of spot rate. Okay, because you enters into forward contract. Therefore, you have to pay Aussie dollar to the bank 322,000 Aussie dollar. Okay, boleh? Right. Now we go to the forward contract specifically. So we have covered the forward rate just now. Forward rate will be used in the forward contract or forward trade. So forward trade can be secured by the forward contract. So this is an agreement under which a business agrees to buy or to sell right, a certain amounts of foreign currency on a specific future date. So the purchase or the sale is made at a predetermined exchange rate fixed at the time the contract is made. Right. So that means, right, in the forward contract, okay, it is a contract where it specify um, the predetermined exchange rate and the specified period, right? For a specific future date, in other words, right? A forward contract is binding, right? The agreed amount of currency must be delivered or paid for an immediately binding contract that is between the bank and its customer. So this is the advantages of the forward contract where the flexibility with regard to the amount to be covered. So it's flexible. Okay. And then it's relatively straightforward both to comprehend and to organize. Then basically the forward contract here is to secure the company. Okay, if the company, for example, if the company forecast that the exchange rate is going to the home currency, right, is estimated to decline in future. So the company enter into the forward contract and lock in the today's exchange rate. Maybe they use today's exchange rate as the currency or exchange rate that will be used in future. So you lock the spot rate to be used in future. Right. So this is normally used by the company when the company forecasts that the home currency is going to depreciate. Why is that? Maybe if they do the import, right, they don't have to pay more in home currency, right? They will follow the exchange rate that is agreed or specified in the forward contract. Okay. Right. Disadvantages of this forward contract, all right. It's a contractual commitment that must be completed on the due date. Okay, right. If you do not execute the contract after the periods specific or specified for this particular contract. Let's say you are not using this contract within 3 months. Let's say the contract is the forward contract here is 3 month forward contract. So if you don't use this within these 3 months, that means you may lose. Or if you what is it? If it's after that means after 3 months the contract is no longer valid, in other words, right. So no opportunity to benefit from favorable movement in exchange rates, right? Unfavorable, no opportunity to benefit from unfavorable movement, okay, in exchange rate. Okay, so that means if you forecast that the exchange rate is going to depreciate, right? So that's why you lock. So suddenly your forecast is not right or not correct. Okay, that means the home currency is actually not depreciate. It's actually appreciate. So that means you lost lah in that way. So you cannot avoid that losses. Okay, right. Okay, so this is the example of the forward exchange contract. Okay, so the example here, let's say it is now 1st January, right? 1st January, and the company will receive $10 million on 30th April, okay, in 3 months' time. And then this company enters into a forward contract, right, to sell this amount on the forward rate at the rate of, so in the forward contract, they have agreed, right, the company and the bank have agreed to set the forward rate at $1.6 per pound, Right, and let's say on 30th April, the company is actually or is guaranteed receive 6.25 million. So now the question here is we want to see, right, whether the company is what is it actually what is it get what they want, all right, for the foreign currency. So here, let's say it will receive $10 million, right? And £1 equals to $1.6. Okay, so if this company received 10 million on 30th April, so that means the 10 million divided by 1.6. Eh? Not any other rates. Let's say the rate at that times on 30th April, or on 30th April, let's say the currency is 1.5, then you cannot use 1.5, right? You have to use 1.6. So this is the rate that you have agreed earlier, and that the rate that you have specified in the forward contract. So you cannot use other exchange rate unless you are not entering into the forward contract. So then you are free to use this. Okay, so this is what we meant by there is no opportunity to benefit from unfavorable movement of exchange rate. Let's say that means if your forecast is not correct. Okay, but in this case, let's say it's correct, and then what? The risk has been, and let's say here the amount that he or that the company received is 6.25 million on that particular date, right? That means the risk has been completely removed. In this case, they get exactly what they should get. Okay, all right, and then the next one is example 2. So this is the current spot rate for US dollar against UK sterling, right? So this is US dollar against pound sterling, and 1 month forward is quoted as, so this is the forward rate, right? So this is the forward rate of 1.4550 and 1.4565. So this is the higher rate and this is the lower rate. A UK exporter expect to receive $400,000 in 1 month's time. So if the forward contract is used, um, how much will be received in sterling? Okay, right. Okay, if the company use the contract, so now the company will what? Receive 400,000. So this is for the exporter, right? Right, because they sell and then they get the sell the goods and services in the foreign countries, which is in UK, and then they get sorry in US, right? UK exporter export goods and services to US, right? And then receive the income in US dollar 400,000 in 1 month's time. Okay, so in 1 month's time dia dah dapat ni $400,000. If the forward contract is used, then how much pound the company will get? So here again we need to determine whether this company, the UK company here, is buying or selling the currency. So the exporter, UK exporter, get $400,000 and wants to convert the dollar into pound sterling. So that means this exporter is selling the dollar, right? Selling the dollar to the bank, right? And then what happened to the bank? The bank will buy the dollar. Then the second step is that you need to determine what rate the bank will use. Definitely, the bank will use forward rate, right? Which is specified in the forward contract. Which one? So this one, right? The one that I have highlighted here. If you are using this one, this is wrong. This is the spot rate. Okay, the current rate. Okay, that is 1 month ago. Okay, the rate of last month lah. Okay, and then here, so the company is selling the dollar to the bank. The bank will buy the dollar. So bank is what? Buy at high rate. So what rate in the for the from the forward contract here? This one, 1.4565. If there is a premium, then you have to minus the higher premium. If there is a discount, then you have to plus the discount just now, right? So since there is no premium and no discount here, so straight away you take this high currency or high rate here, which is 1.4565. So therefore, the exporter will convert the $400,000, then we'll get how much in pound? So you divide by 1.4565, then you get 274, 631 pound. Okay, right. So this is about forward exchange contract. Okay, that using the forward rate. So what is forward rate? Forward rate is the predetermined rate. And what is the predetermined rate? Predetermined rate is the rate, exchange rate that is set today, alright? Sama ada at discount or without discount, with premium or with discount. Okay, and this forward rate will be used in what? Or on the specified future date. Okay, right. Right, and this is the types of foreign currency risk. The next slide, right? There are three types of foreign currency risk that are transaction risk. Okay, this is for short-term exposure, and economic risk. This is for long-term exposure, right? And which is difficult to control and to avoid from. And then the translation risk or translation exposure. Sometimes it is called as exposure instead of risk. If the question use risk, that means it refers to exposure. Okay, so what is the transaction risk all about? So this is about import and export, where payments and receipts depend on the exchange rate. When we are dealing with the foreign countries, definitely that means you are dealing with import and export that involve foreign countries. That means the payment and the receipt must be depending on the exchange rate. And so that means the amount received and the amounts paid for the import, right, is actually subjected to the daily fluctuations of currency. Okay, and economic risk, this is a longer term exchange rate fluctuations that will affect the competitiveness of export and import. Okay, all right. Translation risk or exposure. This is the risk that or the differences that arise when translating the foreign asset and liabilities for accounting purposes, especially when you are doing the consolidation of the accounts, subsidiaries account in the or branches in foreign countries, right? So this is the explanations on the transaction risk. So transaction risk arises from day-to-day fluctuations in exchange rate and the fact that companies have contract to buy and to sell goods in the short run at a fixed rate. So it arises primarily on import and export. So transaction risk, okay, is actually the risk that due to the day-to-day or daily fluctuations in exchange rate. Okay, and the risk here can be avoided, right? The transaction risk here can be minimized through the currency hedging. Right, so it has a potential impact on the cash flow of the company. Transaction risk here, dia akan ada impact lah on the cash flows of the company. Most company will choose to hedge, maknanya to minimize the transaction risk, right? Using the forward contract. Okay, they can use the forward contract, okay, to minimize the transaction risk. Okay, right. So this is the example, right? Then you can go through later on. Example, okay, transaction risk. So simple je example ni sebenarnya. Okay, I think you can go through. If you don't understand, you can ask me later on. Okay, and then long-term exposure, that is economic risk. So this is what I mentioned just now. It's a long-term exchange rate fluctuations that will affect the the competitiveness of export and import, that will make the price of export and import higher or lower. Okay, so this is actually the long-term exposure is actually the is a long-term versions of the transaction risk, right? So this the the risk here may be due to the changes in labor market or government changes, maybe political changes, policy, and so on. That will be making that difficult for the company to minimize or to avoid this particular economics exposure or economic risk. Right? Okay. Then, so this is the explanation. Right? Okay, we go to the translation. Right? Translation, like I said, um, income from foreign operation or business must be translated back to home currency, right? If you have a subsidiary in Singapore, then when you want to to prepare or to report the financial of the company, then you have to consolidate all the accounting figures, right? Accounting information. Therefore, you have to translate back, right, from foreign currency to home currency for this particular purposes, right? And the movement in exchange rate can be changed. The value, right, can change the value of asset and liabilities, right? So, cause the unrealized foreign currency losses or gains, right, when the financial statements are consolidated. So that means, right, the translation is subject to the um, consolidations of the accounting information. Okay, right. Okay, the translation risk, that means refer to the losses that results from the restating the book value of the foreign subsidies asset, right, at the exchange rate on the statement of the financial position date. Okay, so I think you can read here. Okay, another risk that influence the fluctuation that makes the exchange rate fluctuate is what? Political risk, changes in value or in the exchange rate due to political actions or political changes in the foreign countries, right? Like in our countries here, it's not really stable politically. So maybe this will, right, and most probably lah, this will affect these unstable situations. Political instability will influence the exchange rate. So investment in countries that have unstable government should require higher return. Okay, then the investment in our country will be, for example, in our country will be more risky, then the investors will demand for higher return. The extent of the political risk actually depends on the nature of the business, whether that business um, more dependent on other operation within the firms or not. If yes, then there will be less valuable it is to others. Okay, and then natural resources development can be very valuable to others, especially if much of the groundwork in developing the resource has already been done. Okay, right, right. So those are the types of risk. The types of risk are transaction risk, economic exposure, that is long-term exposure, economic risk, and also translation risk. So translation risk refers to the, what is it? Refers to the consolidations of accounting information when you have the subsidiaries or operations in foreign countries, right? And transaction risk is where what? The risk that is due to the daily fluctuations in the currency that can be minimized through the forward contract. And then another one is the economic risk, right? Economic risk is actually is a continuation from the transaction risk. That is a long-term versions of the transaction risk, right? Which is this particular risk normally due to the political or government factors or labor market factors. that makes or that affect the competitiveness of import and export. Okay, right. The next one, we go to the causes of the exchange rate fluctuations. So these are the factors that influence the changes in the exchange rate. So factor ni lah yang menyebabkan exchange rate tu depreciate or appreciate, right? So the depreciation and the appreciations of the currency ni tadi can result in different types of risk tadi, which are transaction risk, economic risk, and also translation risk that affect the competitiveness of import and export, and also the accounting situation, accounting information. Okay, right. And then what are they? What are the causes of the exchange rate fluctuations? The first one, capital movement, balance of payment, purchasing power parity theory, interest rate parity theory, and four-way equivalent. Right. So this is the, what is it? These are the factors that results in the changes in the exchange rates or results in the fluctuations of the exchange rates. Right, we'll stop for now and later we will continue with these courses in the next meeting. Right, thank you. Assalamualaikum.